Shanghai is paying $90.89 for an ounce of silver right now. New York says that same ounce is worth $79 to $70. This isn't a glitch on your screen. This is the opening shot of World War Silver. Today, Tuesday, April 21st, 2026, we are witnessing a 14% price gap between the East and the West, the largest structural fracture in the history of the precious metals market. While American retail investors are watching $88 spot prices on their phones, the physical metal is being vacuumed out of the Western Hemisphere at a rate that hasn't been seen in 8 years. If you think the paper price on the COMEX still dictates reality, you are about to be left behind by the most significant shift in global price discovery since the end of the gold standard. The Shanghai Gold Exchange SGE morning fix today came in at WideWorks 19/935 per kilogram. When you do the math at current exchange rates, that is $90.89 per ounce. In a normal functioning market, traders would buy silver in New York for $80, fly it to Shanghai, and sell it for $90 to pocket an easy $10 profit. This is called arbitrage. But that arbitrage has completely failed. The gap is widening, not narrowing. Why? Because the physical silver in the West is disappearing so fast that there isn't enough deliverable metal to bridge the gap. We aren't just looking at a price difference. We are looking at the total decoupling of the Eastern physical market from the Western paper market. Look at the hard data from China's customs reports for January and February 2026. China imported 206.76 tons of silver in just 60 days. That is an 8-year high. To put that into perspective, that is over 6.6 million ounces of silver removed from global supply in just 2 months. And that is only the official reported data. It doesn't include the silver flowing through Hong Kong or the strategic accumulation by state-owned enterprises. The People's Bank of China has been buying gold for 17 consecutive months, but our intelligence suggests silver has now been elevated to a Tier 1 strategic asset by the Chinese Politburo. They are buying every ounce they can find because they know the Western paper price is a fiction maintained by leverage that is about to snap. While China drains the vaults, Russia has effectively severed its silver supply from the West. Russia is the 7th largest silver producer on the planet, mining 40 million ounces a year. Before 2022, that metal flowed to London and New York. Today, April 21st, that 40 million ounces is completely rerouted to the East. It is being sold directly to China and India through bilateral agreements that bypass the LBMA and the COMEX entirely. This means 5% of the world's annual silver supply has just vanished from the Western price discovery pool. When you remove 40 million ounces from a market already facing its 6th consecutive annual deficit, you aren't just tightening the market, you are strangling it. India is the 3rd pillar of this Eastern shift. The Indian government has set a massive goal of 500 gigawatts of renewable energy by 2030. To hit that, their solar manufacturing sector is currently consuming silver at a rate that is 25% higher than analysts predicted. This isn't jewelry or silverware. This is industrial survival. Indian industrial buyers are now competing directly with Chinese state buyers for the same limited physical supply. This Eastern hunger is the reason the Shanghai premium is at 14% today. The East is pricing silver based on the necessity of industrial production, while the West is still pricing it based on the necessity of protecting over-leveraged bank balance sheets. Now, look at the COMEX paper shield here in the West. Today's data shows registered silver inventory at 76.88 million ounces. But look at the open interest, 575.5 million ounces. That is a 7.5 to 1 paper to physical ratio. We are now exactly 7 business days away from May 1st notice day. As of this morning, April 21st, there are 235 million ounces of silver standing for potential delivery in the May contract. How do you deliver 235 million ounces when you only have 776 million in the vault? The answer is, you can't. We are heading into a massive delivery failure where the COMEX may be forced to invoke force majeure or settle contracts in cash. If that happens, the paper price becomes irrelevant, and the only price that matters will be the physical price in Shanghai. Adding fuel to this fire is the Mexico Section 301 tariff threat. Mexico produces 200 million ounces of silver annually, roughly 25% of the entire world's mine supply. The U.S. Trade Representative's investigation into Mexican manufacturing capacity is reaching a boiling point. If the Trump administration imposes Section 301 tariffs on Mexican exports, 25% of the world's silver supply could be diverted away from U.S. refineries almost overnight. Imagine a world where China is importing record amounts, Russia has cut us off, and Mexico's supply is hit with a 25% tariff. That is the reality facing Western silver holders as we move toward the May 5th public hearing. The macroeconomic data dropping today, Tuesday, April 21st, confirms that we are in a stagflationary trap. U.S. March retail sales came in at plus 1.4%, but this was purely a tax refund-driven spike. The real story is the CPI data. Headline inflation is at 3.3%, but gasoline prices rose 21.2% in a single month. That is the largest monthly gasoline spike since 1967. This isn't just an energy problem, it's a silver problem. Every 10% increase in oil adds roughly 8% to the cost of mining and refining silver. We are seeing a massive cost push inflation hitting the mining sector at the exact same moment that demand pull inflation is hitting the industrial sector. The floor for silver production costs is rising so fast that $80 silver might soon be below the all-in sustaining cost for marginal miners. While this happens, Kevin Warsh is testifying before the Senate Banking Committee at 10 a.m. Eastern today. Warsh is the wealthiest Fed nominee in history, with personal assets up to $209 million. His prepared testimony is hawkish, committing to fighting inflation and saying the Fed must stay in its lane. But here's the catch. Jerome Powell, the sitting Fed chair, is currently under a criminal DOJ investigation. We have a leadership crisis at the world's most powerful central bank during the worst stagflation since the 1970s. When the Fed is under criminal investigation and its nominee is worth $200 million, the institutional credibility of the U.S. dollar is at risk. Silver is the only exit ramp from this institutional chaos. The IMF issued a terminal warning this week, stating that the explosion of U.S. debt is wiping out the safety premium of Treasury bonds. The U.S. is now paying over $1 trillion a year just in interest. When the risk-free asset, the Treasury bond, is no longer considered safe by the IMF, the global financial system resets. This capital doesn't go to zero, it rotates. It rotates into gold, which is holding near $4,800 today, and it rotates into silver, which is the most undervalued asset in the stagflation playbook. The gold to silver ratio is at 60 to 1 today. If it simply returns to its historical average of 40 to 1, silver would be at $120 right now. That is a 50% move just to catch up to gold's current valuation. There's a 24-hour clock ticking on the U.S.-Iran ceasefire. It expires Wednesday evening, April 22nd. Trump has already said it is unlikely to be extended. Iran has canceled talks. If hostilities resume tomorrow, the Iran premium in oil will explode. We could see $110 or $120 oil by Thursday morning. For silver, this is the ultimate binary event. A collapse of the ceasefire means a massive spike in safe haven demand and a massive spike in mining costs. At $80 an ounce, silver is not priced for a renewed regional war. It is priced for a peace that is currently expiring. Let's talk about the Samsung secret that is about to change industrial demand forever. Samsung recently confirmed that their new 1 kilo solid-state battery utilizes a silver carbon layer. This isn't a prototype, it's a production path technology. If solid-state batteries become the industry standard for EVs, the silver demand from the automotive sector could triple. We are talking about an additional 150 to 200 million ounces of demand per year in a market that is already 67 million ounces in deficit. The East knows this. That is why Samsung, a South Korean giant, and Chinese battery manufacturers are hoarding physical metal. They aren't looking at the COMEX price. They are looking at their 2027 production schedules. Every minute of this video has been packed with data because the situation on April 21st, 2026 is moving too fast for filler. You have the SGE premium at 14%. You have China imports at an 8-year high. You have Russia cutting off 40 million ounces. You have Mexico facing Section 301 tariffs. You have the COMEX facing a 3-to-1 delivery imbalance in 7 days. You have the largest monthly gas spike since 1967. You have a $1 trillion interest bill on U.S. debt. And you have a ceasefire that expires in less than 24 hours. If you are waiting for the perfect dip to buy silver, you are gambling against a mathematical certainty. The physical silver market is breaking. The price discovery is no longer happening in New York. It is happening in the vaults of Shanghai and Mumbai. The West is currently short the most important industrial and monetary metal of the 21st century, and the East is long. When the COMEX finally runs out of registered silver to defend the $80 price, the catch-up move to the $90 Shanghai price will happen in a single trading session. The World War silver transition is about the death of paper and the return of physical reality. In 1980, silver hit $49.40. Adjusted for inflation, that is over $194 today. We are at $80. We aren't even halfway to the real inflation-adjusted all-time high. Yet the supply-demand deficit is 10 times worse than it was in 1980. The 20,000 seafarers currently stranded in the Persian Gulf and the triple-digit shipping insurance rates are all signals that the global supply chain is severed. Your strategy for April 21st should be clear. Ignore the $80 paper ticker and watch the $90 Shanghai reality. Focus on weight over numismatic value. Focus on physical possession over digital claims. The COMEX coverage ratio of 13.4% means that for every 100 people who think they own silver, only 13 of them will actually get the metal when the music stops. Don't be one of the 87 people left holding a cash settlement that buys half as much silver as it did the day before. The countdown to May 1st notice day is 7 business days. The countdown to the ceasefire expiry is 24 hours. The transition of power from the west to the east is happening in the silver vault as we speak. This isn't just a trade, it's a generational realignment of wealth. The east is paying the premium because they understand the value. The west is selling the metal because they only understand the price. Make sure you are on the right side of this global shift. I am Stacker Intelligence. I am monitoring the Shanghai premiums, the Warsh hearing, and the ceasefire clock every hour. If you want the truth without the filler, stay tuned to this channel. The window for $80 silver is closing, and it's closing because the East has finally decided that paper is no longer worth the metal it's printed on. Stack while you still can. See you in the next one.